Bank of Canada holds the rate again, and appraisals are coming in short. This means what for the buyer? Yes, all this and more with a good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, back with our favorite mortgage broker in all the land, Mr. Dion Beg. How you doing, my man?
I'm really good, Gary. You always give me a good positive ego boost when I hear those words. Thank you so much.
All right. And today's call's done. Now, on to our Canadian real estate market. There's been lots going on since last week. Different world announcements and things like that, but maybe more closer to home. Let's talk about what's going on here in Canada. Of course, we had the Bank of Canada announcement on January 28th. We're recording this on the 29th, and nothing's changed. And I mentioned yesterday when I was on a webinar, Dion, and I'd love to get your insight on that. That's actually a good thing at this moment, some stability into the Canadian real estate market where perhaps we haven't seen it in such a long time. What's your take on that?
Yeah, I mean, look, I think it's neutral because things are kind of neutral. At the same time, though, they're not moving because they just don't know what's going to happen with tariffs and trade and all this other stuff. And they just don't know how to play the card. So when you don't know what to do, you just stand still. So that is what the Bank of Canada is doing. By the end of this year, we don't know if the economy is going to take a left or a right turn. It's anybody's guess. Right now, in this moment in time, it is kind of neutral. And, the other thing is a lot of people in the industry are hoping for rate cuts, and so am I for our clients, for all of our clients. I don't think, and we've seen this already, like a 0.25% rate drop doesn't make a material impact in people's decision, in my mind, to buy. That's what I've seen in the last couple of quarters as things are sort of flatlined. But what is making a difference, and I've seen this in our business this week, that the sellers are ready to meet the market. And so interest rates, while, if they were to drop, it would be nice. The prices dropping are the things that I'm seeing pull buyers back into the market.
Yeah. And as you said, we still have a little bit of room for it to drop. Obviously, we're at 2.25%. And I wish I had his name in front of me, but the economist from Desjardins Group mentioned yesterday in an article that all evidence points to no rate increases over the next 12 months. And that's a fair comment. I think a lot of people would agree on that. But that also is what people do want to hear, though, is, hey, we don't see our economy changing so drastically where we have to increase interest rates at this moment. And that's a good thing. And we talked about this on our last call and you had mentioned this year is shaping up to be the highest year for renewals. So that's also that'll have a huge factor into what happens, doesn't it?
Yeah, exactly. Renewals are coming into play. And in terms of, Bank of Canada changing rates, it's going to come really down to inflation. And a thing that's going to keep inflation low is the fact that our economy, our population is not growing. It is in fact declining. So for those reasons, I think inflation will be under control. Set aside any international craziness. Yeah,
there you have it. Okay. Speaking of Bank of Canada and valuations and things like that, one of the big components is you have a buyer, you have a seller, you agree on a price.
Right.
Excellent. Congratulations. Your other major partner is the lender, and they have their own opinion of value, an appraisal, and that has not been going as expected for the buyer as of late. Talk to us a little bit about that and some of the hurdles that buyers are facing.
So on the positive side, what I can tell you is in the resale market, where a person is just, say, buying that $1 million home in the suburbs, we haven't had any issues in lenders agreeing that the price that our buyer has paid is the price. Okay. And in fact, I'll tell you that inside of a lender, they have the choice to do a computer valuation on their desktop, or they'll send an appraiser to the property if they feel that maybe they need to investigate whether or not this, deal was at that price, a good price. And what I've noticed in the last couple of weeks is we've had most of our deals get passed by the computer appraisal. Okay, meaning that the transactions that we're seeing are not being challenged or questioned by the lender. Now, on the flip side, pre-construction, it's a totally different ball game. Okay. If we go back five to 7 years, people used to pay 500 grand. And by the time the property was done, it was worth 600. And that's what sort of fueled the boom. We're seeing the exact opposite right now. So just this week, I saw a client purchase, a client approached me last week, purchased a property in Brampton, a condominium, about 4 years ago, and he paid 640. He knew when he called me that the appraisal was going to come in low. We had no idea how low. He was hoping it would come in at 540, maybe 100 grand less. It came in at 425.
Wow.
So we're talking about a massive, I think that's something like a 35% drop in value over that period of time. When I looked at the comparables, because we always see if we have an opportunity to challenge the appraiser on the number they gave us, and there was no opportunity based on recent sales. So and that's one of two appraisals that came in short, but on pre-construction. I haven't, as I said, resale seems fine. Pre-construction is a big concern right now.
And for those that are just tuning in, perhaps for the first time or new to this, remind us again, when appraisal comes in short, what's that expectation of the buyer? What do they got to do?
Yeah, so for the shortfall, they basically have to reach into their pocket and make up the difference, because the bank is going to lend you generally 80% of the lower of the purchase value or the appraised value. So if the appraised value is 100 grand lower than the price you paid, then put simply, you're going to have to raise about an extra 100K from your own savings or your own equity, or borrow from mom and dad. And we've seen all of these scenarios in the last couple of years.
Yeah. A question around appraisals, and of course now we're specifically talking the purchase. Mm-hmm. However, when it comes to renewals and you want to refinance, that typically triggers, or not triggers, but part of the steps from the lender's perspective is, okay, let's have an appraisal done on the property. At that point, Dion, do you have a conversation with the lender, especially if they want to do a computer appraisal on a home that's been renovated or added on to, increased in value from the buyer, from the owner's perspective? Do you encourage them to go visit the home?
Yes, yeah. When we know that there's been a material change to the property that's not visible, from the outside, then we'll say, look, our client did finish that basement, or they did the landscaping or whatever it might be to increase the value of the property. And so we will actually request the lender attempt computer valuation, understanding that it might come in short, and then be okay with the fact that if we send an appraiser there, the appraiser is going to see the value.
Yeah. I think that's important for our listeners to understand the major difference between a refinancing versus a purchase, and from that perspective. Okay. I love that you and your team are in the game, meaning you are talking with clients every single day about what their financing looks like, here's our next purchase, maybe more importantly, hey, here's what we want to do, Dion, help us steer the ship on the decisions we need to make over the next 3, 6, 12, even 24 months, what we need to do. Share with us what's been going on in your book of business over the last couple of weeks.
Yeah, so I've been positively surprised in the positive, which is this particular month of January, we've seen a bunch of purchase deals, which is interesting because, the weather's been terrible, and this is when most people are trying to just stay inside. But I think what's happened is, again, the sellers are at a point where they're ready to meet the market. We work mostly with a lot of buyers, and our buyers have picked up what I would say are some pretty crazy good deals in the current market. So I had a double income family that I've been working with last year set a target price of $1.3 million for their purchase. They've been actively looking in the market with a real estate agent who knows the neighborhoods like inside and out. They came across a property at 1.1 million, so 200 grand lower than they had expected. It ticked all the boxes, and because we had them pre-approved and they could move fast, they were able to pick up that property and become the strongest offer, right? And as is always the case, Gary, everybody says it's a quiet market, but when there's a good property, there's multiple offers always, right? So we were fortunate that we had positioned them that they could actually buy that property without any financing conditions because they had some financial strength. And so they won that property, and they basically feel like they've got 200 grand extra in their pocket, because they've managed to get their dream home at the right price. So that's a great win. At the other end of the spectrum, we have a first-time home buyer. Up until now, I've been living with mum and dad. He makes a good single income at about $110,000, and he said, Dion, I just want a simple purchase, just something comfortable downtown. And he was able to purchase a property in the range of $490,000. Based on his income, and that was a condominium. Actually, it was a bit less than that. Anyways, I can't remember the exact number, but it was well below the number we thought. He did have a car loan, and he did have to finish his car loan, pay it off in order to buy this property. But again, we often have to do that. And in the background, and this is always an important thing, his parents were willing to help if we needed their numbers on the deal. Okay, so what we do on our side is we collect the son's details and the parents' details, and we create a file with just him and with all three of them. And depending on the property, we may or may not need the parents. And in this case, we did not need the parents. So even though we were ready to utilize the parents if the purchase price was actually slightly higher or whatever, we didn't need them. We dropped them off, and he's buying this property totally by himself. And I would say to any of you, you might be the child or you might be the parents in this scenario, but I'd encourage you to just get all your paperwork in so that when you go shopping with confidence. And then at the end of the day, you may not need the parents on the deal.
Yeah, I love it. There's a few questions that came out of that I want to circle back to or get some clarity on for our listeners. And one is when you say, well, he had a car loan and he had to pay it off. Explain to our listeners what that actually means. And I know where their mind perhaps may have went is maybe there's a $25,000 left on that car loan, and the bank is saying, well, pay it off and we'll give you this mortgage. Well, a lot of people don't have that extra $25,000 to pay that off. So explain to us from a financing position and the lender's eyes, what is going to happen from that perspective.
Okay. Well, this particular buyer had $60,000, okay, that he was ready to put towards a purchase. And in his mind, he was going to put that $60K for the down payment. But he did have about a $20,000 car loan. And we're not so concerned about the balance. What the lender is concerned about is the monthly payment. And let's say for simplicity, that monthly payment's $500. Well, that is $500 that's going towards a car payment that we cannot use towards a mortgage payment. And a lot of people don't know this, but that $500 translates to a reduction in borrowing power by about $100,000. So for this guy, it was a very simple math. So when I said, listen, you take 20 grand out of the 60 grand that you were going to use for down payment and pay off your car. By paying 20 grand off on the car, we boost your borrowing power by $100,000, and we no longer need mom and dad on the deal. Okay. And so this is the way that he was able to do this independently without the help of his parents. And in fact, he'd come to me after speaking to his bank, who had told him that definitely his parents would need to be on the deal. And we showed him a way where, again, just by moving some stuff around, he could do this all by himself. So he was super happy with that.
That's excellent. And in some cases too, Dion, we'll see an example where we'll take that car loan as the example. That'll get rolled into the mortgage sometimes. Is that right?
Okay, so important. A lot of people think that they can do this on a purchase. Right. And you can't. This is when we're doing a refinance. Okay. So if you've got a lot of equity in your home and you need to refinance, and we could grab that 20 grand and pay off the car, we will do that. But at the time of purchase, a lot of people think, I can just add the car to the loan. No, you can't. What you're actually doing is you're taking, in this case, 20 grand, paying off the car. You are then in exchange increasing your mortgage by 20 grand. Okay. So it's kind of the same outcome. But we're not rolling it into the mortgage. We're paying it off, and we're increasing the mortgage to replace that 20 grand loss.
Yeah, excellent. That's good clarity. That's good clarity. Mm-hmm. Dion, we've asked this question of you. We probably do it maybe once a quarter, but I think it's about time we do it again as we kind of wrap up here. And if someone's calling you to say, "Hey, Dion, I'm thinking of doing, selling and buying this year," what is it that you would love for them to know even before they pick up the phone and talk to you?
Well, if they're thinking of selling and buying, it'd be really nice for them to have done some research to figure out how much can they sell for. Okay. Yeah. See, that number is so important. And whatever number they give me, I'm going to also shave a little bit off that. So if they think they can sell for $1 million, my first question is, have you spoken to a real estate agent? If the answer is no, in my mind, it's not $1 million, it's probably 950 or a little less. If they have spoken to a real estate agent, then I'm probably more inclined to go with that $1 million number they give me. I also need to know what is the outstanding mortgage balance. So if you owe 600 grand and you're going to sell for $1 million, then I'm going to do some quick math and say, okay, after selling commission and paying off your mortgage, you're going to clear, say, 350 or something like this. Then at least I know now how much we're starting with for down payment. So down payment, figuring that out, that's basic numbers. Also, it'd be nice to know what is your income. This is a simple question to answer for people who get a T4 every year. It's a nearly impossible question to answer for somebody who's self-employed. In fact, one of the hardest questions I ask every day is asking a self-employed person how much they make, because they have no idea. They know kind of what their revenue is, but it's really their accountant who decides how much they make on paper. And so if a person can have that information handy before our phone call, in terms of tax returns, notice of assessments, that type of thing, that would really be helpful.
There you have it, my friends. Dion, remind us how to get a hold of you.
Yeah, at kangamortgage.ca or Instagram at the Dion Beg.
That's right. There's Dion Beg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.